Hello, this is Carlos Asilis from Glovista Investments, here to share our market outlook for the week of February 22nd. First, a brief recap on this past week's major global macro and market developments. On the macro side, the macro calendar has been heavy, particularly on account of a number of diffusion sentiment indicators, both in the consumer as well as in the producer side of the equation. The calendar has been quite constructive, particularly market PMI indicators out of most regions around the world. Accompanying this strengthening of activity momentum, particularly on the sentiment side, has been a continued decline in the number of new cases in terms of the virus, as well as a decline in the number of hospitalizations. The vaccination pace also continues to accelerate despite a deceleration in certain parts of the U.S. on account of the calamities in the Texas regions. So these dynamics on the virus front, as well as on the macro calendar, have helped underpin a blowout in treasury yields and also a further steepening of the U.S. yield curve. Against that backdrop, we've seen 10-year U.S. treasury yields hovering close to 1.3%. We believe 1.5% will be an important resistance over the medium term. But with that as backdrop, we've seen this past week global equities essentially consolidate. U.S. Large caps have been lagging emerging market equities in line with our ongoing thesis, and we expect a continuation of this pattern. Secondly, the blowout in yields helped bring about relative strength out of European markets, given the very heavy value sector representation. In terms of some of the more important fundamental developments this past week away from the macro calendar, we, of course, have to mention the increased expectations of the Biden fiscal stimulus program, likely to be passed close to $1.7 trillion. And this dynamics are all engineering a upward revision to economic growth globally this 2021. Against that backdrop, as we look ahead at the coming week, we have a number of survey indicator releases, including the Richmond Fed, the Chicago PMI, the U.S. Conference Board indicator, along with a number of earnings releases out of the U.S. On the earnings front, we should note that the U.S. earnings season for the fourth quarter has been strong, essentially posting a close to 7% year-on-year growth rate in EPS, with close to 20% surprise factor. The same holds true for Europe and Asia, as well as EM. With that, we wish you a good rest of the week, and thanks for your time and attention.